Boom and bust. What we saw in the previous chart was a series of waves and thrusts and then declines in the overall market. These are commonly known as booms and busts when the moves are very, very severe and involve recessions. So we've all heard the phrase boom and bust, but what exactly is it? Why is it caused? And more importantly, what effect can it have on our investments? What is boom and bust? Boom and bust describes the sequence where an economy, commodity, or market sector goes from surging forward, making lots of profit, and growing at breakneck rates, and is in general, along the way, improving the wealth and standard of living of all participants in the market. Boom is usually accompanied by a significant amount of greed or irrationality about the underlying fundamentals of the boom. This we saw clearly in the dot-com boom, where we were getting ridiculous overvaluations of hot tech stocks in the marketplace. And that was fueled essentially by greed. And Wall Street, as much as anyone else, is susceptible to greed and irrationality. We're not just talking about the general public here, we're talking about professionals. The bust refers to the contraction of previous boom, usually fueled by a significant economic or fundamental change in the criteria that fueled the boom in the first place. This tends to result in various side effects ranging from a reduction in profits, earnings growth, increased unemployment, restriction of credit, and of course a strong change of psychology of the market participants from optimism and greed to pessimism and fear. The chart shows a snapshot of the various boom and bust scenarios from 1920 to 2009, overlaid on the Dow Jones Industrial Average. So here we can see from the 1920s, we have what's commonly referred to as the Roaring Twenties, a very strong boom era. This took the US to a new high in standards of living, but of course, through overstimulation of the economy and bad management of the economy, that was swiftly followed by the very famous 1929 stock market crash, and here you can see a huge plummet in the valuations of the companies in the US and of course in other economies, but it was most widely seen in the US. Then we have a very long period of stagnation. You can see here from the bottom in the early 30s, you can see that a new high from the peak in 1929 was never seen again until the mid-50s. So this is commonly known as the Depression. And you can see here a long period of stagnation over 10 to 15 years. And then, of course, what's commonly referred to as the World War II stimulus reactivated the economy. So the ramp up of manufacturing and stimulus in that area increased the US's output tremendously, and that in turn created full employment and a huge stimulus to the US, which raised the US after the war out of the recession, here, the Depression, and led to a huge boom time from the mid-50s all the way to the 70s. Now, with such massive industrial output, we saw a boom in commodities, and we saw essentially in 1972 the oil shock, which is a pretty famous bust that happened. And following the oil shock, essentially from the mid-70s all the way through to the early 80s, we saw a long period of sideways stagnation and consolidation of the markets. But in the early 80s, there was a new economic boom in town. And you can see here from essentially 1983, 1984, a huge surge in the stock market. And now everyone remembers the famous 1987 Black Monday. That occurred here, but really on the grand scale of things, although the markets fell abruptly and very violently over a short period of time, within a short period of time, within a year, the market had actually recovered. So 1987 was certainly a bust, a very violent and swift bust, but the market itself recovered. There were no screamingly fundamental issues with the global economy at that point. Then moving into the early 90s, we can see a huge boom here, a boom that has rarely been seen in the history of the stock markets. You can see here driving and powering stocks and the standards of living of the people and the countries involved in experiencing this boom, all the way up to the 2000. And essentially that was highlighted, and its pinnacle was in the 2000 tech bubble. Of course, after all huge booms, there comes a bust. And that happened in 2000, and the bust took essentially 3 years to 2003 to work its way out of the system. Now we had a recovery from 2003, mid-2003 onwards, and by the time we rolled over to 2008, we'd essentially just slightly surpassed the tech bubble high from 2000. And what happened? The financial crisis kicked in. So you can see here a whole series of booms and busts, sideways consolidation here, and here you can see another boom, sideways consolidation, boom, a boom, and certainly a bust, a strong bust here, and then a recovery, and then another bust. These are cycles in the market. People claim that the reasons for these are bad management of the economy, overexcitable fiscal and monetary stimulus into the economies and into the marketplaces, which leads to booms, and then the correction is eventually the bust, so that the market re-elevates itself or finds a new equilibrium back to a reasonable valuation. What is interesting to note is that in the last 10 years, from 2000 to 2010, here, the stock market in the US and the UK and mainland Europe have made practically no advance whatsoever. It's been very much a period of sideways consolidation. Regardless of how well individual companies have fared, we have seen very little return indeed in the stock market during this period. So on the grand scale of things, we've had 2 busts in the last 10 years, which have prevented the stock market from accumulating any serious amounts of wealth for buy and hold investors. And a buy and hold investor is someone that may buy an index tracking ETF or fund and hold on to that until their retirement in the hope that they will gain an average 6 or 7% per year. So that will be their retirement fund. So let's ask the question again. Why do booms and busts occur? Let's take, for example, the dot-com boom of 2000. Right here. Greed surged into the marketplace on the misplaced belief that new internet-based technology would fundamentally shift the market dynamic and business models of the future. Technology became fashionable, and bricks and mortar businesses were perceived to be outdated and almost worthless. This paradigm shift meant that money poured into the technology stocks at an unrepentant rate, and money poured out of bricks and mortar stocks at an equal rate. Bricks and mortar referred to businesses that had actually offices and a presence on the high street, factories, etc., those that had invested in bricks and mortar property and buildings. A telltale sign of the problems to come was really noticeable when stock analysts would suggest price earnings valuations on tech stocks of 200, 300 or more. They would suggest these were reasonable even though the companies in question had never made a profit. The price-earnings ratio is the ratio of the stock price to its actual earnings. If a PE ratio is at 30, then it would take the company 30 years to earn back the share price. The higher the PE ratio, the higher the expectation that the stock will perform well in the future. You can also see the PE ratio as a valuation of the worth of the stock. If the PE is 200, you're essentially paying 200 times the earnings capacity of the company. In the year 2000, the PE ratio of the S&P 500 reached nearly 45. This was an all-time high and essentially indicated that the expectation of the market participants was completely unrealistic. By the time the inevitable correction completed, the PE ratio for the S&P 500 had halved to just over 20. Much of the greed and hype was fueled by the professional analysts and so-called market gurus. They became greedy and euphoric, a heady mixture. When everyone slowly began to realize that the huge profit expectations would not be met by the tech industry, the entire sector collapsed, bringing with it other industries, indices, and markets. The tech bubble had well and truly burst. So how does this affect our investments? The boom is good for our investments in the short term, but only if we move into cash before the bust, which of course only the enlightened few ever manage to achieve. And I will certainly show you how to do that later in the course. So let's take, for example, here, if you'd invested or pumped a lot of money into your pension or an investment here in 1988, this would be a fantastic time for your investment and portfolio and net worth to grow. From here to here would be absolutely optimal. Even from the early 20s to 1929 would be optimal. But if you were one of the unfortunate majority who was riding on the crest of greed here in the late 20s, then you could have seen your net worth decrease to a point where you'd be worth less, a lot less, and have lost all your money and maybe even more a few years later. So you can see it's absolutely critical to understand the direction of the stock market, to understand an element of economics, and to know when a great time to be investing is. And in March 2009 would have been one of those potential times to be getting into the market with all the money that you have. So who suffers the wrath of the bust? The private investor, you and I. We lost money in our pensions, our mutual funds, and our stock portfolios. We lost jobs, earnings power, and our appetite for risk. It seems that the time interval between economic crises and the boom and bust sequence is shortening all the time, so it always pays to beware. Whenever analysts are screaming, buy, 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 and acting like the best thing in the world is happening, that is the time to be most careful. When all the market reports are reiterating what a depressing time it is, how there is no future in the stock market, and when prices have lost 20 or even 50% of the value, that could possibly be one of the very best times to buy.
Wow, you're still here. Well, I guess you must have liked this video. If you did, don't forget to hit the like button. It will really help the channel out. And click subscribe if you want to be notified about future stock investing lessons, strategies, and software videos. Finally, don't forget to leave a comment or question below and I will reply.